So NVIDIA's fiscal year 2026, what a ride it's been so far. We're going to break down the first 3 quarters of what you can only call a high-wire act. We're talking about a company that is firing on all cylinders, delivering just incredible performance, but at the same time, it's taking on risks that are just unprecedented. So let's get right into it.
Okay, look at this. This timeline right here, it basically tells the whole story. In Q1, NVIDIA's risk profile is looking pretty good, a healthy +2. By Q2, they're on top of the world. Confidence is peaking at a +4, and then the bottom just falls out. In a single quarter, Q3, that score absolutely plummets to a -6. That nosedive, right there, is the big mystery we're going to unravel today. What on earth happened?
And you know, this quote, it just nails it. The whole conversation around NVIDIA has completely changed. It's not about how fast can they grow anymore. Now, everyone is asking, can they actually manage the insane risks they're taking on? And that's the core of what we're digging into.
All right, let's dive into Act 1 of this story, which we're calling Strength Meets Shock. This is all about the first quarter, where the company got hit with this massive, internally driven problem that really tested its fundamental strength right out of the gate. And here is the first major red flag of the year. The company had to take a massive $4.5 billion inventory charge. Why? Because of new U.S. export controls aimed at China. The effect was immediate. If you look at the official numbers, the GAAP-reported gross margin, it just collapsed by 12.5 percentage points. That is a huge, huge hit to profitability. But, and this is a huge but, that's not the whole story. See, if you strip out that one-time charge and look at the non-GAAP margin, their profitability was an incredibly healthy 71.3%. This tells you that underneath that one-time hit, the actual business, the engine, was running hotter than ever. It was a massive green flag that showed just how resilient they really are.
So what's the verdict for Q1? Well, it was a big deal, no doubt. But ultimately, they handled it. The company proved that its core business was strong enough to just absorb a multi-billion-dollar shock. And that's why we end up with a cautiously optimistic net risk score of +2, which really sets the stage for what happens next.
In that strength, that resilience, it really sets the stage for Act 2, confidence and a colossal bet. Because with that Q1 shock in the rearview mirror, the company's performance went into overdrive, fueling the supreme confidence that led management to make a truly massive gamble on the future.
And this is where all that confidence comes from. Just look at these numbers. The engine room of the company, their data center business, absolutely exploded, surging from over $39 billion in Q1 to more than $51 billion by Q3. This is the financial firepower that's behind every single bold move NVIDIA makes.
And if you peel back the layers a bit, you see just how well they're executing. Compute revenue re-accelerated by a staggering 27% in Q3. That's a crystal-clear sign that their new Blackwell Ultra products are a huge success. On top of that, their networking business had breakout growth earlier in the year. These are the green flags, the operational wins that are fueling this whole story. But here's the catch. To fuel that insane growth, they had to make a colossal bet. Their inventory, the stuff sitting on their balance sheet, nearly doubled, jumping from about $11 billion to almost $20 billion in just a couple of quarters. And even crazier are the supply commitments. These are promises to buy parts in the future, which spiked to over $50 billion.
I mean, just let that number sink in for a second. $50.3 billion. This is a massive, capital-intensive gamble that demand is going to keep growing at this pace. It exposes them to some serious risk, like having to write down billions in inventory if the market suddenly turns south.
So you've got this massive risk building up on the balance sheet, right? So what does management do? They make one of the boldest moves you can imagine. The board authorizes another $60 billion for share buybacks. That is one of the largest on record. It's a huge statement that says, we think our stock is cheap, and we know the cash is going to keep pouring in.
Okay, and that brings us to Q3. And folks, this is where everything changes. We're calling this the geopolitical turning point. The story completely pivots here. The biggest risks are no longer internal things they can control, they're complex external threats from all over the world.
The first shoe to drop is a big one, and it comes from China. Regulators there issued a finding that NVIDIA may have violated the terms of an acquisition they made back in 2019. This is a major red flag. It creates a ton of uncertainty. We're talking about the risk of huge fines, major restrictions on how they can operate, or even changes to their supply chain. At the same time, NVIDIA starts making these huge, aggressive investments, and not just in their own stuff. They're looking at putting $5 billion into a competitor, Intel, and up to $10 billion in the AI company Anthropic. These are massive bets that not only tie up cash, but also mean that a piece of NVIDIA's success now depends on how well other companies perform.
And tied into those investments, a third risk pops up on the balance sheet. The value of their non-marketable equity, that's their investments in private companies, has ballooned to $8.2 billion. So why does this matter? Because the value of these private investments can swing wildly, and those swings can directly hit NVIDIA's reported profits, creating a lot of volatility.
And that's why Q3 is such a pivotal moment. You see, the Q1 charge, that was a one-and-done problem they could manage. This is totally different. The China inquiry, the high-stakes M&A, these are complex, ongoing risks that are, for the most part, completely outside of NVIDIA's control. It's a whole new ballgame.
All right, so let's bring it all together. The final verdict. It really all comes down to weighing these two powerful competing forces that have defined NVIDIA's entire year. Is that scale still balanced?
In this image of a scale, it's the perfect way to think about it. On one side, you've got all the green flags, that amazing operational performance, soaring data center growth, fat margins, and a massive return to shareholders. But on the other side, the red flags are just piling up. Nearly $20 billion in inventory, over $50 billion in commitments, the China antitrust threat, and these high-stakes investments.
And here it is in black and white. The numbers don't lie. We started the year in Q1 with a score of +2, a story of strength. We hit that peak of confidence in Q2 at +4. And then, the geopolitical storm of Q3 hit, driving the score all the way down to a -6. You just can't argue with that trend.
Which leaves us right here, with one big looming question. The story of NVIDIA isn't just about pure growth anymore. It is, without a doubt, a high-wire act. And after everything that happened in Q3, you just have to ask, for the first time in this incredible run, are the risks finally starting to outweigh the rewards?